Well, markets could crash. We've got US bond yields spiking, similar to levels that last caused stocks to fall 20%. My name is Jessica Amir. I'm a market strategist here with Moody. It's great to have your company on this 22nd day of May. We've seen the benchmark US bond yield hit 4.6% overnight. That's a big deal because the last time it hit this level was back in April. And then we saw markets crash with the S&P 500 falling about 20%, the NASDAQ 100 losing 24%. So investors right now appear to maybe getting schooled and stocks are getting hammered. And this is all because bond yields are spiking. We've seen the market fear gauge, which we track on Moody via the volatility index. You can track this just by typing in VIX on your Moody terminal. We can see that the fear gauge has now spiked up to its highest level in 3 weeks, and the level is 21. So why is this? Why is all this happening all of a sudden? Well, bond yields are rising simply because investors are selling out of bonds, and that's because there's concerns rising about America's unfashionably high debt levels. Remember, we spoke about this on Monday, saying that US government debt was at 36 trillion US dollars. That's far greater than the US is making in income or GDP or gross domestic product. So this is the concern. And remember, the concerns rose overnight, pricking up ever so slightly. And that's because now the White House is really pressuring lawmakers to push ahead and pass Donald Trump's basic tax bill that would reduce government revenue, i.e. the amount that they're making in money. So that is also another reason why there's debt concerns are getting louder, because people are worried about how America is on earth going to pay their debt. Now, this concern has been in the air, of course, since we said it was raised at the weekend by Moody's when they downgraded US credit, or downgrading the US's credit rating. That again raised alarm bells about skyrocketing debt and repayments. So it feels like it's Groundhog Day history repeating itself. So in response, this is really important to note, and I want you to remember this, save this video for later. Remember that we are seeing bond yields spike. When we see bond yield spike, it acts as a catalyst for investors to basically take profits out of the share market. Instead, we are seeing investors take their profits and buy into gold and also Bitcoin. Of note, really, we saw an outstanding performance from Bitcoin overnight. Bitcoin pushed up to its highest level ever in history, almost 110,000 US dollars. In fact, it hit 109,500 US. Now, this reinforces the narrative that some have that this is the king of all cryptocurrencies and could be the answer to soaring US government debt. And obviously, Donald Trump passed Bitcoin as a key strategic reserve asset, meaning they're going to buy Bitcoin to essentially push up its price and maybe use it as a vehicle to pay back government debt. That's a story for another day. Across the share market, though, we are seeing trading screens awash with the color of red. Obviously, when bond yields spike, i.e. long-term interest rates, we see interest rate sensitive small caps or small stocks get hurt the hardest. And indeed, we saw that last night with the Russell 2000 index that tracks the 2,000 biggest small stocks in the US. That fell almost 3% overnight. It closed down 2.8%. Now, the blue chip index, the Dow Jones 30, that also copped it as well, losing almost 2%. As for those interest rate sensitive stocks that were hit the hardest, there's one that really stands out that I know some of you are trading a lot, and we're just flashing this on the screen. It's called Regetti. Apologies for mispronouncing that. This is a pin-up small quantum computing company, and of course, NVIDIA allowed the company to speak at their Pin-Up AI conference recently. Now, Regetti was smashed overnight, falling 8.1%. But I think Many investors and traders will now be looking at maybe trimming gains that they've made in small cap stocks such as this, because remember, look, Regetti's had an outstanding run. It's up almost 60% from that April 7 low, but wait for it. As we can see from the chart, it's had an outstanding run. It's up almost 750% since November last year. So there's plenty of fat to come out of this stock, as in there's plenty of gains to be taken off the table. All in all, ladies and gents, I just want you to note that we do have a somber tone, obviously, for the Australian session today. We are expecting pressure to come on those interest rate sensitive tech stocks, and that's because obviously bond yields, as in rising long-term interest rates, that does not bode well for stocks. And until we see the debt issue resolved, I really want you to think about this. This means that concerns are going to linger in markets until we really have a solution or some type of answer as for how on earth the US is going to pay back skyrocketing debt. Now, until then, you will be expecting safe havens to do particularly well. So think about gold, think about Bitcoin, probably to likely gain more ground. Now, as I always say, there's always a bull market somewhere. Perhaps we are seeing a bull market in wheat. Wheat prices overnight hit a 4-week high. So well done to those of you who have been investing or trading in wheat. So what's going on with wheat? So people are basically abandoning their bearish positions on wheat, and that's ahead of some key data that we're expecting to be quite gloomy about wheat. We're expecting to see US sales are actually falling in wheat, and obviously less sales means less supply, while we do have demand rising. So that's why wheat prices are up 5% in 5 days, making them the best performing commodity over the week. Now, this bodes really well for those investors and traders that are diving into wheat. So let's bring up a wheat stock down under. We've got Australia's biggest grain handler. On the screen, we're showing Grain Corp. Now, Grain Corp does pay a dividend as well. It's not just bringing growth, as we can see on the screen from their share price. Grain Corp is paying a dividend gross yield of 5.3%, and that's better than the average yield paid by the entire Aussie share market on average. And bets are out that they'll continue to pay their dividend because they've got almost 100 million in free cash flow, and cash from operations is nearing one of its highest levels. Now, this week, I suspect this overall narrative, add it all together, what do you get? You get lots of brokers upgrading the stock. An upgrade cycle is good for a stock. It means that it could potentially move to higher levels. Macquarie, Wilson's, Ord Minnett all upgraded the stock in the last couple of days. Now, the average analyst sees its shares rising by 15% in a year. That doesn't mean much. It just basically tells you sentiment is bullish for the stock. Whether you believe Grain Corp shares will rise 15% in a year, that's up to you. But I do suspect that this stock will see higher ground. Obviously, as I said, they are Australia's biggest grain handler. They make 72% of their revenue from selling agribusiness products like wheat and barley and canola. And with the US dollar continuing to fall and demand and the supply dynamics there for higher prices potentially for wheat, I think this stock should be on your radar. Lastly, consider if wheat prices do stick to higher ground. It's not good for people like you or I who are buying bread. It's also not good for chicken companies either, because the highest price or the highest cost to a chicken producer is wheat. So this doesn't bode very well for Ingham's if we do see higher wheat prices stick around. And that's it for the daily. Thanks for your company. Stay safe. Happy trading. For more information about stocks and ETFs that we've mentioned today, head over to Moomy's platform.